When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the first 100 days, Trump's impact on your finances, and we'll answer listener questions. We'll also talk about the best places to put your money if interest rates fall. My name's Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. That would be Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. How are you doing?
I'm doing great, thank you. Mother's Day tomorrow, so we salute all the mothers out there. Hopefully you've got reservations at a good restaurant, because you don't have them by now, you're probably not going to get in. But nevertheless, I hope everybody else is having a great weekend. We certainly do appreciate you joining us each and every week here for Premier Retirement. I'll start by giving the phone number today, Jeff, 520-780-9059. If you hear anything that piques your interest, call that number, and we'll get back to you to set up a conversation, 520-780-9059. Jeff, Trump's first 100 days in office since FDR, the first 100 days of a presidential term are viewed as a benchmark for accomplishments, and Donald Trump's second term is bringing a whirlwind of changes. He is sort of taking a wrecking ball approach to things. What is your take on his first 100 days?
Well, my take is the wrecking ball's already been taken to the economy and a lot of things. It's been masked by fake market upside. Most experts have, been assuming there's going to be a recession for over a year now. If you look at all the historical things that I mentioned over and over again, we're overdue for it. And I'm not the only one in that camp. I'm not alone out here. Now, of course, everybody, all the other advisors say, see, you should have been in the market. Jeff's a fool. Well, we were in the market, and our indexed annuities and our LERPs all went up, and our low risk market stuff went up. So we didn't take a beating, but there was some upside that was happening last year and the year before that made it look like the economy was good. But in fact, earnings were worse than they'd been in a long time. 2 years ago, we had an average of 1% earnings growth in the S&P. And last year we had another 2% earnings growth on the S&P. Just this last quarter, we just got through earnings season, and we've had more surprise upsides than we typically have. I think it was closer to like 79, 80% instead of typically around 70% that it has been. So, we did get some, reasonably good earnings surprises. So things maybe are looking a little bit better. I think a lot of that is just people inflating prices and calling it due to, or companies inflating prices, calling it due to the tariffs that haven't really been instituted yet. I think there's a little bit of fake profits out there. So there's a lot of things that are kind of shaky with the economy. Anyway, Trump came in, and I've said this many times, that he's coming in, with a big balloon full of hot air that's going to pop. There's so many bubbles. There's a multi-bubble bubble. And it's an everything bubble is what some experts are calling it. And bubbles always pop, so we don't know when. So I think just the stuff that he's moving around in order to make it so that there is a softer landing than would be if they just all popped and had nowhere to go. If we'd have left things on the same course that they were during the Biden administration, I don't think anybody in the administration would know what to do. At least now we have good economic advisors that actually know how to manage money. We've got businessmen in the White House that actually ran businesses and turned over billions of dollars over time and understand how business works, how tariffs work. They've actually paid them and dealt with them. And I think there's a lot of experience that we have at our disposal now that we didn't have, that typically isn't available in politics. We let these people run our country, yet they, by and large, don't have any business experience. And now we've got people that do have business experience to try to fix things. I don't think it's going to be easy. It's kind of like what Trump has said. It's like you go in for surgery because there's a lot of things wrong with you. It's not that you're going to die tomorrow, but if you don't have the surgery, you're going to die sooner than you would if you have the surgery. The thing is, the surgery sets you back. There's a lot of these little surgical procedures that are going to be better in the long run. Just because you can walk right now doesn't mean you don't need a knee replacement if you want to walk for the next 20 years. And that's kind of like our economy has been really just right up against the edge where we're almost at the brink of failure. Not a no recovery, but a very difficult recovery. You've got Ray Dalio, who we spoke about a few weeks ago, and I've mentioned over the course of the last year a few different times. he thinks there's this massive credit crisis. I mean, he equates a lot of what we're going through, kind of like the Roman Empire. It just got so big, too overdone, and too elite driven. And the peasants just weren't big enough and productive enough to keep the economy or the society going, and it failed. I mean, we're on that track if we don't do something to make sure that the middle class survives, not just survives, but thrives, that the worker that creates the machine, that runs this machine, is able to continue to do so. We can't just keep on sucking tax money out of the wealthy and redistributing it to people that aren't willing to be productive, or to illegal immigrants that don't even have a legal right to be here, that, are sucking economic benefits away from those who are working hard trying to, raise families and live the American dream. I don't have anything against immigrants. I think that, this country was founded on immigrants. I just wish they would come in an orderly fashion, in a legal manner, and come with the right intentions, not with the cartel intentions, or basically let's live the American dream by sucking money out of the stupid Americans that are willing to buy drugs or to leave their property available for us to take. There's a lot of bad things happen. I think Trump's onto something to try to correct all that. So we've kind of got ourselves into a big mess, and Trump's doing the best he can to get us out. I cannot believe the whirlwind of events that have happened in the last 100 days. This first 100 days, I mean, he's a little bit braggadocious, as we know, a little bit egotistical. He says, this is the best 100 days in history. Nothing has ever equated to it. He might be right. I haven't lived through a bunch of 100 days, but I don't remember any time where I can remember news bites being so plentiful, where I remember a president being on camera saying important things and doing important things on a daily basis, and multiples in the same day. It's not just this week something good happened. In a month something else happened. And look, we had 3 things happen in the first 100 days. And we've had like 3 things happen every day for 100 days, as far as things that are noteworthy and newsworthy and may affect our future economically. I think there's still a lot of things to work out with the tariffs. I think the end game is a smart idea. A lot of countries are coming to the table and making deals to where we have more of a free trade arrangement. And we've got a lot of the stuff that was going to China for manufacturing is now going over to India. Look at Apple, the iPhone and things like that they're buying more stuff from them because India's willing to make us a trade deal where they'd be happy to have the business and just not mark it up or not make us overpay for stuff. Also, it gives them a chance not to pay tariffs on some of the stuff that we send them that they want to use, the American-made things that are really popular outside the country. If we look at what's happening in some of these countries, we can see that I think other countries are kind of excited to make a deal and continue to move forward. Vietnam was one that called like the same day the tariffs went into effect, said, hey, we'll be happy to go 0 to 0. I mean, done, let's do it. Vietnam imports a lot of leather goods and a lot of different things from down there. I know they come here and buy a ton of used Levi's and take them home. I've seen that in the airport 100 times. They like American goods too. I don't know what the tariff deal is on the stuff going from here to there, especially used clothing. The stuff that comes from there can be made on a competitive basis. If they're not going to charge us a tariff, they'll be competitive to Chinese stuff and maybe even make a better product. So I think China's probably got as much to lose as anybody. We've got a lot to lose, maybe short term. Like I said, it's kind of like getting gut punched or maybe having an operation where we're laid down for a few weeks. But when we get up, we can work better than ever going forward. The other thing is there's workarounds. I mean, China's not the only country that can build stuff on the planet, especially when you've got huge populations in India and other countries that are just aching to work, that have such a poor, lower class and middle class that they'd be happy to rise up and have more opportunities to build things, sell things to the U.S., especially, and take some of the market share from the Chinese. I don't think, and I mentioned this before too, I don't think China has as much at stake or as much interest in making sure everybody of their 1.5 billion population thrives. They just want the middle to upper class, the people that are thriving, to continue to thrive. And they do that based on the fact that, everybody else works and is fuel for their machine. America, on the other hand, we want everybody to be lifted together, that no one's left behind if they don't want to be. We do support those that can't help themselves. We do have laws against sweatshops and abusing the working class and things like that. China's got kind of a different deal on their end. I don't think they have to make any moves because they don't believe they're in a position that they're going to be worse off if they don't make a fair trade deal with the U.S. But I think if this thing lingers too long, we're going to find that it does create some economic problems and it needs to be fixed. But I think the first 100 days and the start that we got, Doge finding all the wasteful spending and the billions of dollars, $1,000 per taxpayer, that's pretty darn strong. We've got a lot of things that are getting put into place that I think are very positives for the long-term outlook for America and making it great again. Unfortunately, we've got one side of the aisle that likes the gravy train and doesn't really care about the people, and they care more about themselves than the country, and don't want all these abuses to be figured out because they're living off of them. They're getting rich off of them. And they're kind of like, in a way, their own little political cartel, and how we think such evil things about this Mexican cartel and all the evil that they're perpetrating. I think you can turn it around, and the politician club, the Washington club, may be just as evil and self-centered. And although it's not perhaps dealing drugs, I mean, maybe they are, or maybe they're creating an environment where they can. Maybe they're also getting kickbacks from the cartel. It wouldn't surprise me. In fact, I think it probably is happening. But they benefit by all this crappy stuff that they let happen because they're the buffer between it, and they know that they can get rich by it. So if Trump in the next 100 days or the next 3.5, 4 years can be to find the rest of the garbage being dumped and clean it up, I think we'll be looking at a much brighter future in a few years, even if it means we go through some recession. Recession is a reset period. We have recessions. We've always had recessions. They're going to happen again. I think this is a great time to have a recession. So we start off on better ground. We start off on a more firm footing. We start off where stocks are valued at a price that makes sense. And a lot of things just come back to be more logical again. It's time that the world makes sense again, and it hasn't for a while. And I think Trump's trying to get order and make sense of it, even though with all the news bites we hear and all the feedback with the oppositions, people that hate Trump and hate what he's doing, are muddying the waters, clouding our vision a little bit and making it seem like there's more chaos going on than not. And I think it's more of a calculated, methodical transition than we are led to think or led to believe based on all the noise that we're hearing and all the crap that's on the news that is very honestly and very often fake news. And I think Trump's got that part right. Anyway, I think we're off to a good start. I'm optimistic. I was optimistic that Biden would do better and he'd be off to a good start. I cheer for the president no matter who's in power. I want America to be a great place. But when they keep on just being morons when it comes to economic policy and upholding the values of the majority of the American citizens, then the rooting doesn't work. It's hard to like somebody that's ruining the country that you grew up in, that you thought was going to be great forever and be a great place to raise your kids and grandkids, et cetera. But I think we're trying to get back on track. I hope it works. And I hope the politicians that are in the swamp don't ruin it for everybody by trying to keep things status quo.
We're talking with Jeff Ogden of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about Trump's first 100 days. If you're interested in our conversation today, maybe you want to talk to Jeff about Trump's first 100 days, some of the things that are happening, and how it may affect you and your journey towards a prosperous retirement. Again, you can give us a call here at Premier Retirement and request a Premier Retirement Roadmap Review with Jeff. 520-780-9059 is our number. 520-780-9059. Phone lines are open right now. Call that number, leave your name, telephone number. Shelley will call you back during the week and set up that appointment. Again, no cost, no obligation whatsoever for this casual conversation. 520-780-9059. You can also find out more about the firm online at premret.com, PREMRET.com. Jeff, let's continue our conversation here about Trump's first 100 days. The market started the year off at an all-time high or near it, and it would be an understatement to say that the new tariffs have caused some extra volatility. So let's say that you're looking at retiring in maybe a year, 2 years, 3 years. Should we be really reacting to this market volatility? Do you think that this is something that's going to continue, or should we just stay the course?
Well, if you've got a long-term perspective, stay the course, keep dollar cost averaging in with your new money, because volatility actually helps you. If you're getting ready to retire and I've talked to so many people that just a few months ago had $1.5 million or so in assets and stocks and bonds. And even with this recent bounce in the stock market, they're still down under $1 million, or just finally got to $1 million. Now they're scared, like, oh man, $1 million was always kind of my number. I knew that if I had at least $1 million, I'd be okay. Well, wouldn't it have been nice to get out right at the top? Unfortunately, that's like a 30% loss. The market's not down that much. Well, there's a lot of stocks that are. NVIDIA was up in the 140 range. Now it's in the 110 range. That's down 25, 30%. That's a big stock. There's other stocks that are half of what they were 6-8 months ago. We got companies like AMD, the second biggest chip company, I think, in the planet. They basically are half the value that were a year or so ago. There's a lot of really important companies that supply a lot of economic benefit to our world, not just our country, that are getting beat up. And it kind of shows that we're maybe not really as strong ground as we should be. We've got a market cap weighted index that kind of shows us when we have 7 stocks making up 30% of whether the stock market goes up or down, and those are driving the market. It's kind of easy to not really see the full picture of the economy or what the market's really doing. So as far as volatility, yeah, a lot of people experience volatility and they're wondering why they've taken some big hits. And honestly, I think if you look at where the market is and where the indexes are, they're still near their all-time highs. The last 2 years, we had 20% or better returns 2 years in a row. The last time that happened was right before the big dot-com bubble. That doesn't happen very often. The dot-com bubble, we know, was huge. I mean, tech stocks lost 80% plus. The S&P over the next 2 years or so was down more than 50%, and so was the Dow. Both of those indexes took almost 7 years to get back to their high that they were right at the year 2000 mark. It was 2007, they were peaking out, and then guess what? It did it again. So, and not so bad on the NASDAQ this time, but the S&P was still down over 50%, and so was the Dow. And that took another 4 or 5 years. Actually, it took to 2014, almost 7 years since the crash started when the peak was hit in 2007. So again, a 7-year cycle, both times the market corrected last time. And we're kind of in another era where we've got the overdone hype on AI, which was similar to the overdone hype on the dot-com bubble. So it's very smart to respect what the market can do because history does repeat. And if we think it's different this time, we're going to be in for a surprise because over the last 100 years, nothing seems to end up being different. It shows up in a different look, but it always still happens. The market still corrects. The market still goes down. We are still due for a crash. We are still near all-time highs. The old adage, buy low, sell high, is a good idea. If you buy high and end up having to sell low, and why would you have to sell low? Well, if you're using that money in retirement because you need it for income, you would have to sell low if you put everything in the market or kept everything in the market right now. So my opinion is, how would you like to be right, whether you're right or wrong about the market? Well, you can be by protecting those assets and principal protected accounts that have upside. And if you look back, if we could go back 10 years and invest in something that's available today, and of course it wasn't available 10 years ago, but if you look at just the markets, if you look at how money transitions from one asset class to another during bull and bear markets and everything in between, I mean, you can build models that can be principal protected and still make over 10% average rate of return based on today's interest rates. If you're only investing in a 1% interest rate environment, indexes are kind of hard to beat the market. But right now, you've got a 5% return on low risk investments in the bond market that you can ladder a bond portfolio, and insurance companies can do this for you, invest the interest in indexes and make double or triple of what you can make in interest on a bond portfolio. And they take the risk on the principal. So you don't take a big bond price hit like we did over the last few years in the bond market, down 20 or 30% still, by the way. So, I mean, there are ways that if the market goes up, you get the upside of the market leveraged with the interest that you make on bonds with no more risk than a CD. If the market goes down, well, then you don't lose money. I mean, what's wrong with that? Now, we could say, well, yeah, but if the market goes up another 20%, I make 20. On that other thing, I only make 10. But if the market goes down 50, you lose 50. And on the other thing, that only makes 10, you don't lose anything. So, when it comes to protecting retirement dollars, I think it's smart to respect volatility and to also respect history enough to know that our market is still near an all-time high. It's not too far off the all-time high. It's still within 10% of the all-time highs of the indexes on all indexes. Maybe the Russell might be a little lower, and that's really the true gauge of the market, which is actually not performing quite as well. But the Dow, which is cap weighted, the NASDAQ and the S&P 500, which is cap weighted, have kind of given us a fake scenario of how the overall economy and how the overall market has been doing lately. But if you're looking at where the market is compared to traditional valuations, we're probably close to double priced, almost twice the price that the average stock market has sold at for the last 100 years. So if you consider it could go down there, it may not, but it could. Why would you take a risk with that other $1 million or the $1.5 million that you have in the stock market? It would have been good to take some off the table when you got to the million first, then make some money and risk what you can afford to lose and risk money that doesn't make you scared. I've had people come in the office like, oh my gosh, the market's gone, I got to get out. How fast can you get me out? Oh my gosh. Like, well, gee, then that was scared money before. You just finally got scared today. You shouldn't have been in the market if it's making you that scary. You can't time when all these things are going to happen, but you do know that they are going to when certain conditions exist, that we're probably due for a recession. We've been overdue for the recession actually by, 6 months or more outside of the typical range of when it occurs. So the fact that Donald Trump is doing crazy stuff and causing chaos, if it wasn't what he's doing, it would be a different excuse. It would be earnings, or it would be who knows what. It could be a number of things that just have to give the market an excuse for a sell-off. But we know that institutions have been selling off for a long time. We know that executives in companies, Jeff Bezos, Zuckerberg, Jamie Dimon, those people have sold hundreds of millions and billions of dollars of their own stock. Why? Because they know it's at a good price to sell. Institutions have divested huge percentages of their holdings. They're typically the inventory holders. They are the inventory holders. That's why we call them market makers. They've divested about a third of their average holdings, and households are now 50% increase in households that own stock. So private households that own stock, when that gets high, it usually means when more dumb money owns stock than smart money. And I don't mean that people that live in households are dumb, but we call it dumb money because they don't have all the information that Wall Street has. Wall Street's selling and Main Street's buying. Well, that's usually a bad sign. So let's respect volatility. Let's respect history. Let's not take risks if you can't afford risk. But if you were at $1 million or $1.2 million or $1.5 million even, and that would have been plenty to live on in retirement, but under $1 million, you're getting to that point where you can't. I'm not going to say the market can't go down more. Some people are saying, well, yeah, but I have to wait till it gets back to $1.5 million now before I sell. Well, then it gets back to $1.5 million. You're not going to want to sell because the market's going to be on a tear. It's going to be rolling forward. Why would you want to sell then? Anyway, bottom line is you have to be smart with your money. You have to set aside profits. You have to take profits on a regular basis, especially as you near retirement, and park those funds in a safe place that can create income, can create predictable income that aren't going to keep you awake at night and going to supply what you need. And that is a replacement of the income you used to get from a paycheck. You need those paychecks now from your investments, and you can't get paychecks, or you can't count on paychecks coming from a volatile asset. I have clients that are still working. They don't seem to be worried about the market. Well, I wouldn't be either, but wait till they stop working. It's going to be a whole different story when all of a sudden they're taking $10,000 a month out of their retirement accounts or their investment accounts. And when they see the market going down, they know they're selling more shares of stock this month than they had to last month. And it can get worrisome. There are plans and there's ways to take advantage of locking in your profits along the way, sell when it's high. And by the way, the market, in my opinion, is still high. It's not a bad idea to take some profits off the table and only risk what you can afford to ride the wave with. I believe there's going to be a lot of waves. I mean, we're not done seeing what we've seen so far this year. It's going to continue. It's going to be a choppy market. It's going to be surprises probably every day, maybe even several times a day. So either get used to it or take some of those profits off the table and start sleeping at night.
We're talking about Trump's first 100 days of office with Jeff Ogden of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And I think the takeaway is don't let the short-term changes in Washington overwhelm you. Political winds come and they go, and your long-term planning should be relatively unaffected as long as you keep your eyes open and you jump on opportunities as they arise. And as far as future taxation goes, you can mitigate that by converting to Roth or other tax-free buckets, but don't allow fear or uncertainty to consume you or influence your decision-making. Again, if you have listened to this conversation with Jeff, his comments have piqued your interest, you want to come in and sit down with Jeff and talk to him with a casual conversation, we invite you to request your Premier Retirement Roadmap by calling 520-780-9059. 520-780-9059. You can call that number right now. All you've got to do is leave your name, telephone number. Shelley will call you back during the week and set up a time that's convenient for you and Jeff to talk about your plans for a confident retirement. Again, there's no cost and no obligation. 520-780-9059 is our telephone number. You can also find out more about our firm online at premret.com, premret.com. Jeff, let's take a break. When we come back here on Premier Retirement, we're going to be answering listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Ogden and Jeff Shea.
We so much appreciate you joining us each and every weekend for Premier Retirement here on 790 KNST, Tucson's most stimulating talk. You're hearing us today. We're on the air for you 4 times a week. Saturdays at 7 a.m., also at 9 a.m. and 1 p.m., and Sundays at 11 a.m. And also, we are a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Ogden. You'll find this show, many of our past shows. You can stay on top of your journey towards a confident retirement. And also, you can simply Google Premier Retirement with Jeff Ogden, and that will point you to our many, many podcasts. And we've got podcasts on almost any subject that you can think of. It's a good way to spend a little time in the car listening to a Premier Retirement podcast. Okay, Jeff, let's get to listener questions. And today we will start with Sheila listening to us in Tucson. Sheila says, my sister is 62, is married, and has a learning disability preventing her from gainful employment. Her husband, 63, takes care of her, has only a high school diploma, and is not motivated to do more than delivering for Instacart. He squanders any extra money that he gets on himself. My husband and I supplement their income. I'm 72 and I'm looking for advice on how to provide for my sister after I'm gone. I want to make sure that my brother-in-law can't get access to the money. So, Jeff, she's got a problem there. Where do you think we start with a solution for this?
I'm kind of leaning toward the insurance company's safe money side here. There are insurance companies that will actually let you do what's called an irrevocable beneficiary designation, where you can decide how exactly that person is going to get your IRA, for example, when you die. It might be something that you set aside, and I don't know if it's your IRA, it could even be non-qualified investments. You could also invest them in something that gives you income till you die, but any balance of the account would go to your sister over 10 years in equal installments or something like that. And, nobody can actually really get in there and change it. You said she's just a learning disability. Does that mean she's incompetent, can't sign her name, or can she still sign her name and do things? It sounds like maybe, or maybe she can't. But the other thing you can do is a trust, where you put somebody in charge of those funds. Now, a trust company is typically very expensive, and they self-serve quite a lot, and I don't really recommend it if you can avoid it. But if you have a brother, sister, or a child that you trust, I don't know if they were able to have children or not, but somebody close to the family that's younger than you that might be able to take care of that and heed your wishes as to never allow anything to go to the husband, but only go to your sister's care and only be used for health, education, maintenance, and support. Now, if she's on any state benefits or any government subsidies and things like that, she may actually have those taken away should she be found to have more than like $2,000 in her bank account at any given time or something like that. Now, I think there's also a spousal resource allowance that they'll allow her husband to have. Again, you have to be really careful about not dumping a big lump sum of money that she can get her hands on and ruin the possibility of continuing those benefits. And when your money runs out, then she has to go back and reapply. Who knows if those benefits and those programs will still be available. They might be grandfathered in for her, but maybe not available again in the future. So we use special needs trust. I have a special needs daughter, so I know how these things work. I have a lot of clients that I've met through Autism Society and different things that have special needs kids, and we take care of that kind of a thing through trust, where you just have somebody take care of their special needs. And the language in the trust would dictate basically that this person can get whatever you want to give them up to the point where they would lose any benefits that they would be entitled to through agencies, DDD, some of the local charitable organizations, et cetera. And it doesn't mean you can't take them with you on a nice family vacation and spend a ton of money at Disneyland with them or whatever, in a little bit more of a subtle way, but you can't just plunk a bunch of money into the bank account. I suppose you could probably take them to Nordstrom's and buy some really super expensive clothes and go over those limits, but I don't know that that would make a lot of sense. But there's a lot of ways to be flexible with those expenditures and not be sticking that money in a bank account that would be scrutinized in a way to lose benefits, or be in a way where husband, the spendaholic and not too responsible with money guy, can't grab it and spend it on silly things. So there are some ways, probably a trust, finding somebody that you do trust. They call a trust for a reason. You have to trust a person you put in charge. And if there is someone trustworthy that you feel will outlive you and maybe live as long as your sister, maybe it's another younger sibling of yours. Maybe you have a younger sibling that you think is in good health and might be able to take care of that for her. But anyway, a couple of ideas. Not sure if we've covered all of them, but those are the first ones that come to my mind.
Jeff, if a trust is set up, is it possible for the money to be paid directly to a healthcare provider, something like that? Then it would bypass a bank account that the husband could get his hands on. Is that possible?
Yeah, absolutely. The trustee can pay bills on behalf of the sister anytime that they want to or need to. For the provision in the special needs trust language is that you're able to pay the bills for or on behalf of this person, in so much as it doesn't affect their ability to collect other benefits. So yeah, you can pay directly to the providers. You can pay directly to rent for the house or whatever. You can do those things.
And Jeff, we can help her with that trust here at Premier Retirement?
Sure, we sure can. We do them for our clients. So obviously I've needed trust in my own family's life. So I've become a certified estate planner, understand trusts, how they work and how to set them up efficiently. And when I don't know the answer, I know the smart people that are way above me and know those answers. So we can get it done.
Sheila, thanks for listening to us, and give us a call here at Premier Retirement. Talk to Jeff about your particular situation. 520-780-9059, 520-780-9059. We'll also send you out Jeff's book, Retirement, The Road Ahead. Our next question, Jeff, is Russ in Green Valley. Russ writes, It looks like a recession is on the horizon. Surely the time has come to take action. I've noticed you've been giving people advice on what to do, or more precisely, what not to do in the weeks and months since the election of President Donald Trump and his announcement of tariffs. I don't pretend to understand all the details, but I do know that the market has suffered, and along with it, my 401k. I'm 57, and retirement is within my grasp. The economy appears to be slowing down. What can I do, if anything? I feel like I'm fiddling while Wall Street burns.
Well, I don't know if Wall Street's burning or just kind of, flames
Smoldering.
popping up here and there, putting it out. But I think it's certainly got there's certainly a good chance that it can. If we go into recession and there's what we call capitulation, when you have 60% of households, private households owning stock, there's a lot of people that are a little more skittish than, say, the typical institution that would just buy and hold and just keep things for a long time. These are people, a lot of them are day traders, a lot of them are new to the business of investing because of the stimulus that's been handed out over the last 4 or 5 years since COVID and things like that. And if there starts to become a massive sell-off where people are start getting scared, they're going to run for the doors and going to feel like somebody screamed fire and they're going to be running. So those are things that can happen when we get to conditions like we're in right now. I'm not calling for it. I'm not expecting it. I'm just preparing for it. And if it does happen, I don't want to have my money that I need to use in retirement lost or have to wait 6 or 7 years for the market to heal itself, the economy to get back on its feet, and for us to get that money back. I think it's smart to take profits off the table. With all this tariff talk and things like that, I don't know what you have in your 401k, but you're 57, you're not too far away from retirement. It might be smart. I mean, if you have $1 million in your 401k, maybe you have $1.5 million. Well, put $1 million into something and build a pension for you so that in 5, 6, 7 years from now, you're going to have $80,000 a year in income to supplement your Social Security. And then you don't have to worry about what happens in the market and the other $400,000 or $500,000 that you have sitting around. If you have $500,000, put $200,000 or $300,000, and maybe you make $20,000 or $30,000 for retirement income 8 or 10 years down the road. There are products that you can use at your disposal that can build your own retirement with income rather than just say, well, let's see what the market does. I hope I can retire, or I hope I have enough, and I hope I retire when the market's high, and I hope I can get it out in time and put it somewhere safe, or I hope I don't retire when the market's at its bottom and I have to spend that money when it's only worth half of what it is today. Those are all kinds of things that I can't imagine you not losing sleep over. I mean, those are important things. And if you're expecting recession, you get a little bit nervous, then let's look at the profits you can take off the table. Let's look at some guarantees that you can set into place for the future. If everything's in a 401k and you're 57, you can't move it around until you're 59 and a half, we may have to just take kind of a more subtle approach and just take some profits off the table, go safe, make a few percent interest without loss, and then dollar cost average into the market with all your new money. And that would still end up being a way to build wealth, but at least give you a predictable income for down the road. And if the market does crash and we have a recession and this capitulation that happens, when people run for cover, you might find a great buying opportunity and get in some of the stocks that you love at half price what they are right now. And that would be great for your retirement. It would help build wealth quickly without losing in the meantime. You can't afford at your age, in my opinion, to ride the market down 50% just to ride it back over the next 5 or 6 years back to where you are today. Let's get some of your money off the table while the market's near all-time highs. It's not at all-time highs. Nobody's ever going to time it that perfectly. But hey, if you're in the 90% of all-time high range, you're still getting out at the top, in my opinion.
Russ, thanks for that question and listening to us in Green Valley. Of course, you'll get Jeff's book, Retirement, The Road Ahead. And again, give Jeff a call, 520-780-9059. Request your retirement roadmap. You can do that right now. Next question, Jeff, is Mike listening to us in Marana. And Mike says, I'm 64. My wife is 62. We plan to retire in 3 years. We have $750,000 in a retirement plan. Social Security will cover our minimum dignity floor in retirement. My question is about a pension. I'm being offered a lump sum that would be about $300,000, but the monthly lifetime benefit would be around $1,300 a month. Should I take the lump sum option for my pension, or should I take the lifetime benefit?
Well, I think lifetime benefits are kind of cool because if you run out of money, they still pay you that $1,300 a month. I will tell you, though, with $300,000 at your age, and especially if you're going to retire in 3 years, you could have a plan with $300,000 that instead of putting your $300,000 into an income plan that should you and your wife both be hit by a bus, you don't get the $1,300 a month and that $300,000 is gone. You could put the $300,000 into a plan that has a good historical rate of return with principal protection and guaranteed income for life. That income at your age, I'm just going off a whole bunch of illustrations and these plans that I've put in place in the last several years, but I would say somewhere between $1,500 and $1,800 a month would be a more normal income that you could probably get out of that. And the best thing is, let's say 10, 12 down the road, there's still $250,000 in the account. You've taken that money out and you get hit by a bus. Guess what? Your heirs get the remainder of the account. It doesn't go to the insurance company or the pension company. That money is yours. Let's say 10 years down the road, you get a terminal illness and say, gee, I've got $250,000 in that account still, and I only get my $1,500 a month. Well, that's boring. Somebody's going to just be left with a nice chunk as an inheritance. Now, it could go to your spouse if that's needed, or it could go to your kids, whatever. Or you could say, you know what? I need that money to fix my house and make my life comfortable for the last few years. And I want to just spend the $250. You can actually get that lump sum back on whatever the remainder of that lump sum is for those type of expenses and those type of emergency needs. So I think there's a way to do a self-funded pension that you deal with pension companies. These are companies that offer pensions. I'm not going to name names because people will say, oh, that's a recommendation, or, well, that product sucks because it's not for me. Well, every product has a different reason and a different focus and a different bell and whistle that might be right for you. So I would pick there's a couple that I'm thinking of that have huge participation in the pension market, that do deferred comp plans and do pensions for many of the government workers and first responders, things like that. And they offer personal pension opportunities through annuities that you set up, where you get income and you still have access and you still have control and ownership of the balance of the account. So it's unlike the typical investment like Social Security, where you put money in and you hope you live long enough to get it all out, or the pension where you give up that $300,000 death benefit or lump sum benefit for a $1,300 a month benefit that may or may not last as long as you do, or may not even outlast the account value. So there are some other things you can do. And by the way, I know that your Social Security will probably cover at least that dignity floor in retirement, but you might want to consider that $300,000. I'm not sure how soon you can move that. I'm guessing maybe only at the time of retirement, but let's just say you put $500,000 of that $750 in something that would generate you maybe $2,000 or $3,000 a month in retirement income guaranteed to supplement that. And then when you retire, then you take that $300,000, put it back in the market. By then, maybe the market's corrected and it's lower than it is now. And it might be perfect timing where you can go back into the market with some of that money. So again, you have access. I assume that $750,000 in retirement plans is either in 401ks or IRAs. When you're 59 and a half or older, you can take money out without penalty. You can move it from 401ks generally. Almost all 401ks allow that. Or you can move it to self-directed IRAs and you can build your own pension in an IRA that would still be tax deferred until you retire, but give you that guaranteed income you can count on. So I would look at those numbers and I'd show you how to build a retirement plan that would generate, I could see you living on at least $100,000 a year in guaranteed income and still having some liquidity to play with and some market exposure where you could have some fun when the market goes booming to the moon and not worry about it if the market crashes, and kind of give you the peace of mind that you're looking for in retirement, income in excess of what you probably think you can live on, in excess of what the pension shows that you should be living on, and do a little bit better if you be creative, use all the tools that are out there. We can show you how that works if you want to come in.
Mike, we appreciate you listening to us in Marana, and of course, give Jeff a call, 520-780-9059. We may have a few more questions to ask you to guide you in the proper direction, but I think taking the lump sum sounds like the best advice right here. If you've got a question for us you'd like us to answer on the air, you can get it to us two ways. One of which is you can call Shelley, 520-780-9059. Dictate your question there. Or you can go out to our website, premret.com, PREMRET.com. Use the contact page there and put your question in. If we do use your question on the air, of course, you'll not only get a good answer, but you'll get Jeff's book, Retirement: The Road Ahead. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And again, if you would like to sit down and talk with Jeff in a casual conversation, get your no-cost, no-obligation retirement roadmap. 520-780-9059 is our telephone number. Jeff, if Donald Trump influences interest rates to fall, that typically means that the Federal Reserve is expected to cut rates, which has wide-ranging effects on the economy and financial markets. So let's talk about how falling interest rates will impact different investments and where it might be best to put your money. Let's start off with stocks. How will falling interest rates affect the stock market, do you think?
Well, it kind of depends. Typically, if it's just a matter of interest rates going up or down, if we're not on the brink of recession, lower interest rates really help tech companies. A lot of them have a lot of debt that they have to service at floating rates. Cash-dependent firms like low interest rates, obviously. Low interest rates might help the housing, the building markets. They'd have to get lowered a lot more than they are right now in order for it to make a big mark, because interest rates, while the bond market's been falling continually, more on a downward plane than an upward plane for the last several months, It's effectively been raising interest rates. And even if Powell decides to lower interest rates 5 times over the next year, like he did 3 times last year, even though the rates were lowered, he lowered the short-term overnight interest rate or the Fed funds rate 3 times for a total of 1%. During that same period of time, the actual interest rate on bonds, anything longer than 3 months, actually went up 1%. So, a 6% mortgage went up to 7, 16% credit card probably went up to 25. I mean, the interest rates actually went up, not down, even though Powell says they're going to lower. So it's lip service to the markets. It usually gives people like, oh, good, interest rates are going down. That means all these stocks are going up, and the money starts flowing into the stock market, and the institutions love it because you got a whole bunch of dumb money players, Main Street players, just buying the market up because they're buying it on hype. And the institutions are like, heck yeah, you can sell mine at a higher price. Here, we'll just raise the price and sell it to you because you're in a frenzy and you'll pay more for it than it's worth. And that's what the market's been doing for the last couple of years. Is the market makers have been kind of just deciding what price to charge stuff and unloading their stock at higher and higher prices. And honestly, there are ways you can see it. I spent a lot of money for intel on the market. One of the things is you can tell what the volume is, whether it's selling volume or buying volume. And now, if there's always the same amount of sells and buys in a day, because you have to have a seller and a buyer, right? You can't have more sales. However, sales volume means who's initiating the trade. In other words, who wants to sell, and then somebody willingly comes and buys it for a price. But if you're selling a stock, typically you have to lower the price to get a new buyer in that isn't already out there. So the market usually falls with more sellers. But more often than not, it seems that the market's going up even when there's more selling, which means I think institutions are setting prices and manipulating the market. So there's a lot of that kind of stuff going on that I think we have to be a little bit concerned about. So interest rates may or may not even play into it. Now, back to the interest rate question. If the Fed starts lowering interest rates, typically, if we look at history, and again, history repeats, if you say this is going to be different this time, that's the most dangerous words you can learn in the investment world, is it's going to be different this time, or it's different this time. John Templeton said that, and I think he was right. He was more of a contrarian investor. You always buy when people are selling and sell when people are buying. And remember, the market is the market. The market does what it wants to, when it wants to, not on your terms. It does it on its terms. So just know that it's going to repeat. The cycles are going to correct. The cycles are going to complete eventually. We don't know when, but we have to be prepared for it. So interest rates, if the Fed lowers interest rates, every time there's been a recession after yield curve inversions uninverted, we had that. I've talked about that several times. That happened in January, where the long-term interest rates finally went higher than short-term interest rates for the first time in about 2.5 years. At 30 months, typically it's less than 2 years. Took a little longer for that to happen. Typically recessions happen after that yield curve uninverts 2 to 6 months later. Well, we're about 4 months later now. You have the Fed also drops interest rates at least 2 times before the recession starts. Now, I don't know if you can call the last year's lip service drops being really drops or not, but when the Fed says we're going to lower interest rate, it kind of admits to, oh, we're in a recession. We need to lower interest rates because things are going to blow up if we don't. Things are going to be really hard if we don't. Nobody can buy a house. I mean, people already aren't buying houses. People are walking away from escrow because they're worried about the economy and worried about the interest rates that keep going up. Interest rates keep going up. For the last 2 weeks, they keep going up when it seems like there's pressure that should be making them go down. Some other anomalies that end up happening, interest rates go up usually makes the dollar stronger, which when the dollar's strong, the gold prices usually don't go up. When dollar's weak, gold prices go up. When interest rates go up, the dollar strengthens. Well, that's weird. You've got the dollar supposedly going down in value, even though the interest rates are going up. And if interest rates go up, they usually cause the dollar to go up. And also if interest rates go up, typically gold doesn't go up, but gold is on a tear again. So it had a little bit of weakness over the last week or so, and then it started back up on its upward, very good momentum on the upside. So there's a lot of disconnects in the market. There's a lot of things that I think a drop in interest rates, although would help the market a little bit just from the standpoint of it sounds good and it makes people get kind of in a buying frenzy. It also helps people think, oh, good, maybe I can afford that house because mortgage rates might go down. But 1/4 or 1/2 point interest rate decrease isn't going to make a difference. Today or tomorrow, it might do it. A couple of days rally in the stock market, but it's not going to make people run out and buy houses. Interest rates have to fall probably 2 or 3% before that starts happening at a clip that makes sense economically to be cheering the housing market. It would have to go down 1 or 2% probably before all these people that borrow money are going to be excited about being able to borrow money and create more expansion for their companies, for their production, for their infrastructure, for their hiring and things like that. And by the way, hiring it beat expectations last month, but it was pretty dismal. If you take the last 2 months of increased jobs, I think it was flat or negative. So that last hint of economic growth was pretty anemic if you look at the real numbers, and it was a lot of hype that made the market continue its bull streak, and now we've seen some weakness come back into the market recently. So I think we're kind of at a point, an inflection point, where we're pushing up to about as high levels as we're going to get in the market for a while. I don't think we're going to test the top. I think we're going to test kind of right where we're at right now, which is around the 200-day moving average. That's a technical term. I probably shouldn't go down that road right now on a radio show, but bottom line is there's a lot of reasons that the Fed should lower rates because I think we are in recession, but as soon as they lower them, they admit to it. And I think a lot of players in the market take that as a sell signal, which would make the market probably crash more than it would make the market go up, given the status that we're in. Dropping the interest rates, even a half a point or a quarter point or a full point, would rally the market. But because the market's already rallied in the face of all these interest rate hikes and so-called cuts that weren't cuts, I don't think it's going to work the same this time. I think it's going to be an admission that the economy is going into recession, and I think that might be the catalyst for the next sell-off. So I'd be very cautious with the interest rate decreases. And when Powell gets up there and says, hey, we're dropping interest rates, I wouldn't go running and start buying tech stocks like crazy. That time ended last year and the year before. I think now we have to be a lot more cautious going forward.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the effect of interest rate drops on different investments. Of course, we've talked about the stock market. Gold and precious metals, they often gain value when rates fall, the dollar weakens. However, gold and precious metals certainly are more volatile, and they really don't produce any sort of income, but they can be a good hedge. Again, if you have questions of Jeff and you'd like to get in and sit down and talk with Jeff, have a casual conversation about your retirement roadmap, we are offering just that, a retirement roadmap, absolutely no cost, no obligation whatsoever. You've listened to Jeff in the radio program today. You know that he has a lot to say about almost everything. If you would like to, again, have that casual conversation with Jeff at no cost and no obligation, ask the questions that apply to you personally. Call 520-780-9059. It's 520-780-9059 and request your no cost, no obligation retirement roadmap. You can make that call right now. Leave your name, telephone number. Shelley will call you back during the week and set up a time that's convenient for you and Jeff. And again, there's no cost, no obligation. 520-780-9059. You can also find out more about us online at premret.com, PREMRET.com. Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank our fine listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade, wishing you a great weekend and a happy Mother's Day. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.